Today's Tuesday Tidbits, we're going to be talking about the difference between a traditional IRA and a Roth IRA. I hope you enjoy. So today we're talking about the difference between a traditional IRA and a Roth IRA. And there can be some confusion out there as to just what they are and what they do for you. To start with, a little bit of history, the traditional IRA became a part of tax law in 1974. So it's been around for a while. And what the intention of that plan is to allow somebody to put money in an account, deduct, in most cases, the contribution that they're making into that account, allow the account to grow tax deferred. So if you think about it, none of the money has been taxed in that account. And then when they go to take distributions out, they'll pay taxes at a later date. So if you think about, you might use the language, they're called a tax deferred account, but think of it more as a tax postponement account. And sometimes that'll give a little bit more clarity as to what we're doing. We're not eliminating the tax, we're postponing it to a later date. Now the Roth, on the other hand, was enacted in 1997. So it's the newer kid on the block. And the Roth IRA was designed to allow somebody to put money in the account, not get a deduction. So they're not deducting the contribution. The account grows tax deferred. And then in the future, as long as the distributions are what's called qualified distributions, then all of the money comes out income tax free. So if you think about it from a kind of a pure example or an analogy, if you were a farmer and the IRS came to you and said, okay, we're going to give you two options. You got to pick one, and whichever one you pick, that's what you're going to stick with. We'll either allow you to deduct the cost of your seed when you get ready to plant, but then you're going to pay tax on your harvest. Or you can forego deducting the seed, so you'll buy your seed with after-tax money, but then you'll get your harvest tax-free. So that gives you a little bit of a mental picture as to the difference between those two accounts. And people will often ask, well, which one's the better one? Well, it really depends on individuals. It depends on your situation, depends on where you are on the tax scale now, where you think taxes are going in the future. And each of those counts is going to operate or respond differently, depending on where you are, where you think you're going to be, and ultimately where you actually are. But you can be very proactive as you look at creating accounts that are going to impact different things and have different tax structures. Ideally, you'd like to go into retirement with different accounts that have different structures so that you're not painted into a corner where every dollar that you've got is in, let's say, for example, a taxable position, so that every time you pull a dollar out, you ring the IRS cash register. But again, it's going to depend on your situation. And interestingly, we're in one of the lowest income tax scales that we've been in history. The highest the tax has ever been was 94%. That was back in the 40s. The federal income tax at one point was 94%. That's kind of shocking to believe. So we are in a lower tax rate. There are a lot of factors that could potentially impact these things in the future. If you have questions about these kind of topics or anything along that line, please feel free to give me a call here at Westside Advisors and Insurance Services, and I'd be glad to discuss them with you. I hope you have a great week.